Welcome. Today we're analyzing a powerful convergence shaping the global economy when big tech officially adopts the private equity playbook. We call this the $1 trillion cash playbook. We are witnessing a monumental shift where the world's largest technology companies are moving beyond simple growth and embracing the disciplined, value creation strategies of private equity. Giants like Apple, Google, Amazon, Microsoft, and Meta are quietly becoming some of the largest private capital allocators on the planet. This entry into traditional PE territory is reshaping competition, deal pricing, and the exit pathways for every startup. The strategic intention behind this shift is far beyond simple financial returns. It's about ecosystem expansion and securing long-term control over critical infrastructure across diverse industries. Our goal today is to provide a thorough strategic breakdown of this critical tech PE convergence, offering clarity on its mechanisms and implications. We will explain exactly why technology giants are behaving like structured investment firms and how this fundamental shift impacts founders, investors, regulators, and professionals across both finance and tech. Post-2022 market resets forced big tech to aggressively prioritize profitability, automation, and operational efficiency. As core market revenue growth slowed, they had to seek new, more stable return engines outside of their saturated core business lines. This marks a massive transition from risky moonshot R&D to high ROI optimization across global industries. PE-style ownership allows big tech to apply their superior AI, automation, and cloud tools to older businesses that desperately lack tech capabilities. The era of near-zero interest rates is over. Today, capital efficiency is the new playbook. Big tech is focusing on acquiring or investing in stable, recurring revenue businesses with predictable cash flows, which are typical PE targets. They are applying classic PE-style cost optimization, automation, cloud migration, and AI-driven workflows, which can instantly improve a target company's earnings before interest, taxes, depreciation, and amortization, or EBITDA. This strategic pivot is largely necessitated by market saturation in their legacy business lines. Core markets like smartphones, cloud, social media, and advertising have matured. To satisfy shareholder expectations, big tech must enter new verticals such as healthcare, logistics, industrials, and finance. Private equity investments offer a lower risk path, giving them immediate exposure to these new sectors without the long, costly process of building a new division from scratch. Now, let's look at the financial engine powering this shift. Big tech's unparalleled $1 trillion cash advantage. Big tech collectively holds over $1 trillion in cash and short-term investments, a level of liquidity unmatched by any traditional private equity firm in the world. This massive reserve creates a war chest for large-scale buyouts, strategic minority investments, and opportune partnerships. It enables aggressive, opportunistic buying during economic slowdowns when target company valuations dip. Imagine the scale. This cash advantage provides a level of financial flexibility that simply dwarfs the assets under management of even the largest traditional PE players. To put it in perspective, a single tech company like Apple often holds more cash than the entire annual GDP of some smaller nations. Moreover, companies like Microsoft and Google maintain consistent free cash flow generation that exceeds the annual capital inflows raised by most traditional PE funds. This immense liquidity enables rapid deal execution. Big tech doesn't need to slow down for fundraising cycles or complex syndication, allowing them to snap up valuable assets much faster. Big tech also benefits from a lower cost of capital and, crucially, an unmatched level of patience compared to their PE counterparts. Unlike traditional private equity, which typically operates on a 7 to 10-year fund cycle requiring an exit, big tech can hold assets indefinitely, allowing for deeper restructuring and multi-decade value creation. They can also accept lower initial financial returns if the acquired investment strongly benefits the broader tech ecosystem, such as increasing cloud usage, gathering valuable data, or driving advertising revenue. This capital is being deployed using classic private equity strategies, buyouts, carve-outs, and roll-ups. Big tech is increasingly investing in companies the way PE firms do, targeting profitable, asset-heavy, and strategically valuable entities where a tech injection can drastically improve margins. Carve-outs are also essential, allowing big tech to acquire underperforming divisions from large corporates and apply their modernizing operational leverage to streamline them. These transactions target predictable cash flow businesses and focus on streamlining divisions using big tech's core technological strengths. A prime example is Microsoft's acquisition of Activision Blizzard, driven not just by content, but by massive revenue potential and expansion of the gaming ecosystem. Amazon often carves out specific logistics and fulfillment technology from smaller providers, integrating them into their superior infrastructure to improve efficiency. Similarly, Google regularly acquires cybersecurity firms, which strengthens its enterprise suite and solidifies its position in the highly profitable cloud security market. The true superpower of this convergence is big tech's ability to inject AI and cloud capabilities directly into non-tech businesses to drastically boost margins. Big tech utilizes sophisticated AI automation, cloud cost optimization tools, and proprietary data platforms to instantly improve the operational efficiency of the acquired non-tech assets. This approach generates superior value, increasing EBITDA faster than traditional PE playbooks and creating immediate cross-selling opportunities back into the tech ecosystem, whether it's AWS, GCP, or Azure. Next, we examine the crucial roll-up strategy, consolidating fragmented industries like vertical SaaS and logistics. Big tech can consolidate small, fragmented industries, a strategy private equity firms have used for decades. However, they bring technology upgrades at scale, enabling them to quickly create multi-billion-dollar industry dominance. Common examples include highly fragmented markets like specialized healthcare technology, vertical retail software, fleet management, and complex fintech infrastructure. What is the impact of this new playbook on the broader startup ecosystem and the future of innovation? The preference for operational PE-style investments means fewer traditional, large-scale strategic acquisition exits for high-growth, venture-backed startups. Early-stage innovation may slow down, as founders anticipate fewer M&A outcomes. The competitive dynamics shift from disruptive R&D innovation to achieving PE-style operational excellence. This convergence introduces severe new regulatory and antitrust risks that global bodies are only just beginning to grasp. PE-style dominance dramatically increases consolidation risk and amplifies market power concerns. Regulators worry about multi-industry domination and expanding data monopolies. Systemic risk increases significantly because big tech controls both the core digital infrastructure and a growing slice of real economy operations, creating dangerously interconnected tech finance behemoths. The expanded market power raises amplified antitrust concerns over anti-competitive practices globally. The FTC in the US, the EU, the CMA in the UK, and India's CCI are all closely watching large-scale buyouts and, increasingly, the patterns of roll-up acquisitions. Key regulatory concerns include reduced competition, high customer switching costs, and the potential for cross-subsidization abuse, where digital advantage and capital advantage create unmatched market dominance. The focus is intensifying on the micro-roll-up strategy and the emerging too-big-to-fail paradox. Hundreds of small acquisitions, or micro-roll-ups, may individually fall below statutory disclosure thresholds, allowing big tech to consolidate industries without immediate regulatory oversight. Regulators fear that if big tech becomes deeply embedded in too many essential economic sectors, it creates a new too-big-to-fail risk, moving beyond banking and into interconnected tech finance ecosystems. In conclusion, the convergence of big tech and private equity is not merely a trend, it is a structural change. Big tech has officially entered the world of private capital, fundamentally changing the rules of the game. Sector expertise, combined with data power and AI operational capability, creates an unstoppable investment engine that redefines deal-making and competition. Finally, this shift has significant career implications, creating high demand for specialized M&A and AI operational experts. The merging of private equity discipline with deep AI and technical skill sets will become the new premium professional profile. New roles are emerging, such as cloud optimization PE analyst and operational transformation director. Let's quickly recap the core elements of the big tech PE playbook and its long-term implications. Big tech is building diversified multi-vertical investment empires that will compress returns and increase competition everywhere. Understanding this convergence is now crucial for anyone working in finance, technology, or regulation.